The broadcast is now starting. All attendees are in listen-only mode.
Hello, everybody. We'll be getting started in just a second. All right, I guess we're going to get started. Welcome, everybody, to the RetailStat, formerly Credit Intel Executive Review on Housewares and Home Furnishings. This is Al First. I'm with Dave Silverman. So today we're going to be discussing the home furnishing segment, looking at some trends and some peer comparisons. I'm sure many of you have been on these calls before. So we're going to open up with a little overview of what's been happening in this segment in particular. The big 20,000 square foot look. So I guess for starters, if you look at the end of 20 and 21, just post COVID, the segment, retail in general, but this segment in particular had pent up demand. People were saving their money, not really having anywhere to spend it. You had a lot of government stimulus come in, people focusing on their homes. So a lot of extra demand in the market. And then at the same time, you had an impact on supply. So COVID actually impacted shipping and production, and it shut down parts of China. So you had inadequate supply. So you had a big mismatch, too much demand, not enough supply. And then that led to, pretty much everything flying off the shelves, anything that was left. So there's full pricing, no promotion. So this is the environment that we saw in late 20 through most of 21. Then if we shift from the end of 21 through 22 and possibly even parts of today, the pendulum has reversed. Inflation has caught up to consumer spending habits, so demand is down. Supply has actually caught up. And initially at the end of 21 into early 22, you had that sudden shift where all of a sudden, like I said, supply caught up and people stopped buying. So you had this excess inventory on hand, which resulted in really a surge in debt and a crimping of liquidity in many retailers. You saw the behemoths like Walmart and Target seeing a sharp impact to their profits, but it actually impacted the potential survival of a lot of smaller and less sound businesses. So moving forward into early 23, and I guess we'll start with, you see the final departure of Bed Bath & Beyond and Tuesday Morning. But I would say, though, is that, these two weren't really a victim of the macro issues that, I've been talking about. I guess for starters, if you go to 2021, neither really benefited a lick from all that surge in demand. So similarly, they didn't get hammered, but, they had their own issues. Bed Bath, boy, we've talked about that at numerous alerts and months, but a lot of that was changing of private label and their product offering and the supply issues. So we could talk about that for hours. But and then Tuesday Morning, this is their second filing. The first one was pretty much at the beginning of COVID, and even after they closed half their stores, there was no improvement in performance. So those guys were, I would not say indicative of the segment trends. Although if you want to add Christmas tree shops, they're kind of somewhere between a mass merch and a home furnishings retailer. They filed recently and somewhat limited disclosure, but I do think a lot of their issues were tied to supply chain, elevated costs, and then the consumer restraint that we've seen more recently. As we move through 23, now we're approaching, the halfway point in a little bit. I would say the inventory positions are in much better shape now, but we still haven't quite seen much operating improvement. I think the good news is that I think we've seen some normalization finally in supply and demand, where they're matching much better than they have over the last couple of years. So, the outlook going forward, though, is, consumers are still pressured by that inflation. You've had 2 years of cumulative inflation building up, and, prices are high, and now it's starting to really impact the pocketbook and savings, et cetera. Interest rates are higher. Retailers are seeing some relief in freight costs being down substantially, but other costs are up. Labor, shipping, product costs, all these things are much higher. And as you see sales starting to normalize a bit, deleveraging of revenues, that's making some other expenses get more costly. So it's hurting margins overall. The chart at the bottom shows pretty much first quarter figures, and as we're saying, sales are down pretty much across the board. Aaron's is the one that was up, but that was due to an acquisition. And then as we look towards later September or so, student loan payments are going to resume. So that's going to be yet one more crimp in the spending patterns of shoppers going forward. If we look at sales overall, like we said, things are mostly down a bit despite the relatively high inflation. I think Williams-Sonoma is the one company that had a little bit of a bump yet, but this is full year, trailing 12-month sales. Their latest quarter that just came out, sales were down 7%, and actually for the full year, they're projecting sales to be flat, or pretty much somewhere between -3% to +3%. So Williams-Sonoma, and we'll see it in the following slides, is pretty much by far the strongest retailer in this bunch. And their sales are down in the first quarter, and at best they're expecting flat sales for the year. Another one that's not listed in here, but we footnoted, is Home Goods. They're part of TJX, so we didn't want to include all of TJX since Home Goods is only like 15% of that company. But Home Goods itself has about 900 stores, about $8 billion in revenue, and sales last year were down 8%, and first quarter they're down 3% again. So even the stronger players are seeing that top line pressure.
I was just going to comment on Aaron's and Upbound. Aaron's was the only increase, and the reason is that the figures are not really comparable to last year. Sales are up there due to the acquisition of BrandSmart, and so BrandSmart now comprises about 26% of the total revenue, and so Aaron's is comprised of the two parts: the legacy Aaron's unit and also the new BrandSmart unit. But despite the overall increase, the legacy Aaron's segment had sales that were down about 8% in fiscal 22. And that was due to a combination of factors such as a smaller lease portfolio, a lower rate of lease renewals, and lower exercises of early purchase options. And this is, I'll get into it a little bit more, but this is part of the lease to own business model that they're under.
Okay, if we look at comparable store sales, and it starts getting a little skimpy with data here, but Container Store didn't report same store sales last year because they felt it wasn't a good comparison. We've had a lot of volatility in the markets over the last few years. But while their full year comps were down 3.7%, their latest quarter, which was 4Q that just ended most recently, was down 13%. And for the full year, they're already projecting comps to be in the negative mid to high teens. So you're talking 17, 18% drop in comps for the full year they're already projecting. So, like I said, I think 23 may be a bit of a challenging year for some. Kirkland's, now you can look at it as an improvement from negative 15.8 to negative 4.4, but that's on top of the negative 15.8. So, 2-year stack sales are down 20% on that 2-year basis. Williams-Sonoma, like I said, they're the strongest player here. Their sales dropped to negative 6%. If you combine the 2 years, sales were positive 3.5, but more significantly, if you go back to when that strong 21 I mentioned before, their 3-year comp is about 45%. So they had that one mammoth year that really bolstered the whole thing.
And as you can see, Upbound had the lowest comps. Just parenthetically, Upbound is a combination of the legacy Rent-A-Center and a new company called Acima, which I'll get into a little bit later. The comps there were down over 6%, and that came on top of a negative 1% comp last year. And the reason that is common to the lease-to-own niche is that the subprime customers that they cater to have less money for discretionary purchases, and because of that, a lot of times they're trading down.
And so if you look at the store count chart and what's going on with store growth, et cetera, I think I would generally say that, retailers, they always want to be opening stores, right? They want to grow if they can. So that really relies on A, do they have the appropriate capital? And then B, to some extent, on their most recent performance. So considering that, like I mentioned, 21 was such a strong year, and I think some of them thought it was going to last forever, it's no surprise that shortly after there's, more expansion plans in the works. Container Store is a good example. They hadn't really opened too many stores in a bunch of years prior, but then suddenly, despite only having about 97 stores currently in operation, they're planning to open 76 stores over the next 4 years. Now, how quickly times can change, that plan was announced maybe 6 months ago, something like that. And suddenly you're seeing, the expectations on the top line and the sudden hit already. So I think we're starting to see even the openings for this year, they're starting to slow it down a little bit and tap the brakes. Home Goods, strong operator, adding 50 stores this year. Williams-Sonoma, very interesting. Like I mentioned, they're one of the strongest in this category. Now, their plan is really to focus on online sales. They've actually been closing a small amount of stores over the last few years, but they do about 65% online, and they would like to grow that even maybe a little bit more. So, that's their plan, and it's working. So they want to keep growing, but focus on online. Ironically, Kirkland, I think in some ways, it looks like they want to mimic, Williams-Sonoma, but they only do about 28% of their sales online. And so they obviously rely on their stores a bit more, and yet they're still closing stores. By the end of this year, they just mentioned they're going to probably close another 10 to 15 underperforming stores.
Both the Upbound and the Aaron's units are, their store bases are contracting relatively slowly. Both of them have relatively small stores. The Upbound stores average about 4,800 square feet. The legacy Aaron's stores are about 6,000 to 15,000 square feet. And with the acquisition of BrandSmart, those stores are actually very large. They average about 100,000 square feet. And neither of the companies has any plans for large expansion. I'm going to get into a little bit of the direction that Upbound is going, and it's going to be more virtual than in store, but I'll get into that a little bit later.
And then the last one I didn't mention was At Home, which is still growing as well, and that's a good segue to our first spotlight retailer, At Home Group. And a lot of interest in this one, being that they're private now. I would say in some ways they're a little bit of a victim of their own success. I mentioned how strong 2021 was for the segment in general, and it didn't take long. I think it was even April when the acquisition announcement came out, and by July they had completed an LBO by Hellman and Friedman, and it was a $2.8 billion deal. Now the problem is that at the time they only had $300 million in debt, and that has grown to over $1.4 billion as of the acquisition date. So, substantial jump in debt, and by itself, probably not all that problematic, except for you're basing it on performance that was unrealistic to maintain. So obviously, performance did not keep up, and comps were down 7% last year. I think mid-year was probably down in the mid to high teens. Fourth quarter is down 12%, so maybe it's starting to improve a little bit. But certainly they were burning cash. They had some of the same issues with excess inventory others had, so it was really starting to eat into the liquidity. Last summer, they expanded their revolver to bolster liquidity a little bit. They had a few $100 million. And then most recently, they had an announcement in May where they did some refinancing. They issued another $200 million in 11.5% notes. And they also did an exchange. So it was at a 10% discount, but they swapped out a bunch of unsecured notes for new notes with security and with a PIK option, which PIK means payment in kind, which means that you do not have to pay cash for it. You could just add it to the balance of the notes. So, so assuming that they use the PIK option, which I'm sure they will, otherwise they wouldn't have done it, the cash outflow should be pretty neutral as far as how much interest expense is, cash interest expense. But if they weren't to use it, it would result in about a $30 million increase in cash interest each year. So, once again, this debt keeps rising. Net total debt is up about 165 million. If you look at the chart on the bottom right there, as of end of July or so, the last kind of full balance sheet we had, that was up to about 1.8 billion. Remember I said it was 1.4 at acquisition date, so it kept growing. So yeah, almost 1.8 billion at that point. Now, the company positions it as they're looking to take advantage of opportunities created by the recent competitive exits in the sector. So, hello, Bed Bath & Beyond. Now, that might be possible. It still might be the convenient excuse versus that they were short on liquidity and they needed to raise funds. So that, extra 200 million, certainly helps. As far as them being able to take market share from others, absorb some of the Bed Bath business, it's possible. Our store trends data showed that about half of their stores are within 5 miles and about a third are within 3 miles of the final 375 Bed Bath stores that were closing. That means probably even more overlap if you look at the full segment. I'm not sure they're going to really get a massive change of performance from Bed Bath, being it's been over a long portion of time and there's so many people that may take sales from them. But bigger picture is At Home. They were opening 25 to 30 stores a year, prior and coming up to pandemic. In 22, they still opened 13 stores, which was probably close to half of what they had hoped for. But I mentioned the struggling performance, etc. And the company told us that for 2023, they still plan on adding 8 to 10 stores. So this is based on they have a little over 250 stores currently. So they continue to open stores. So to me, that shows they may have some concern, but I don't think there's any panic there yet. And Hellman and Friedman, they had put in 500 million in equity, and they're only 2 years into this acquisition. So while I think At Home could become a bit of an issue, a bit at risk, especially later on, and there's a lot of concern on this company overall. There is a lot of debt. I do think there'll be a little bit of patience. So, we'll see how that goes going forward. Gross margin. So from these numbers here, we're showing that gross margin fell from 46.3% to 43%. So it's a nice little drop. Now remember, this is like the full year. So it's kind of 22 versus 21 essentially. And what we're looking at is, this past year, I mentioned before about how demand slowed and inventory piled up and promotions were starting to really rise to push out that extra inventory and raise cash. So it's really no surprise that, margins were going to fall under those circumstances. I think in 2023, one thing we're seeing is an improvement as far as merchandise margins, because especially freight costs that were astronomical have come way back down into normal territory.
Yeah, I can just add on gross margin if you want. Aaron's actually had the largest reported decrease, but that was again due to the acquisition of BrandSmart. The reason being that BrandSmart is a pure retailer, whereas Aaron's is in the lease-to-own business. And the reason for the higher for the change in gross margin is that a lease-to-own company reports revenue that includes finance income. And for other companies that report that, they report it separately, and so we back it out in our computation of gross margin. Companies in this industry don't do that, and that's the reason that generally, the legacy Aaron's was at a higher margin, and now you see the decrease when the pure retailer at the lower margin comes into play.
And as we head to like SG&A margin, this is pretty much your overhead, and essentially almost all of them are up except for Aaron's. I guess overall costs are up, inflation, labor, shipping, etc. I think I alluded to before, as top line sales normalize, this huge spike, and now it's starting to recede back to normal territory, maybe even lower. That starts to offset that leveraging of the sales that you had on your fixed costs. So as sales fall, your overhead costs as a percentage of sales are going to start to increase. And then shifting to EBITDA margin, well, this is pretty much an accumulation of your previous two slides, gross margin and SG&A, and considering both of those were going in the wrong direction, it's really no surprise that EBITDA margin it came down quite a bit from 14.6, which I think was a somewhat elevated level, down to 9.3. RH and Williams-Sonoma remain way at the top, even though they're being pinched a bit as well. Wayfair fell into negative territory. The one positive there is they're expecting, and they've made some good strides to be EBITDA positive in the current, upcoming quarter that's going to be announced. And they've been kind of a unique company, a lot of investment, a lot of looking for a lot of growth and everything. And I think they're finally realizing what's a little bit more of a normalized sales level, so they're cutting costs to be more appropriate with the size of their operations. So we'll see if they can sustain that positive EBITDA.
And I might add that for Aaron's and Upbound, both of those had a drop in EBITDA margin. Both of those have been taking pretty significant write-offs and also a lot of delinquencies. Basically, this is because certain customers are buying product, and because of the economy, less discretionary income, more focus on necessities, they're not able to pay for their purchases. And so these write-offs have had a significant impact on them.
Okay, and looking at CapEx margin, this is your capital expenditures divided by total sales. And that increased quite a bit from 2.9% last year to 3.7%. So you have some aggressive spending here. I think this is partially derived on, remember that strong end of 20 and 21. So I think there was a lot of, growth anticipated. So starting with Container Store itself, like I mentioned, their CapEx is almost double what it was the previous year as they start to expand and open some of those stores. I would say overall, again, this is margin based. So as sales levels normalize, if CapEx stays the same, your CapEx margin is going to go up. I do think a lot of these companies are investing in logistics and their omni-channel and that sort of investment. And I think everything just costs more in general as well. So, unless operators kind of like Kirkland, where their cash is getting tight, otherwise you're going to see, companies investing that and trying to grow. Shift to Dave for a spotlight on Upbound and Aaron's.
Sure, thank you. So as we've been discussing, operations have been deteriorating at both of these companies. They both sell home furnishings on a lease-to-own basis. Generally, lease-to-own companies do best in a climate of moderate and stable financial distress. They don't do well when there are rapid changes in the economy. And so I think we can say that over the last year, the changes in the economy have been fairly rapid, and it's reflected in some of the unfavorable results of these companies. And, looking toward the future, a lot of that depends on how deep the recession is going to be and how quickly things change. But basically, management in both these companies says essentially that they have not yet hit their sweet spot. And so that remains to be seen. As I said before, Upbound, it's a new name for what used to be Rent-A-Center, and they now operate under two units, the legacy Rent-A-Center and the new Acima that they acquired a couple years ago. And Acima provides lease-to-own services to third-party retailers. The customers of both of these companies, Upbound and Aaron's, are subprime borrowers, which essentially means that they can't purchase products from traditional retailers using cash or credit. They have lower incomes, and they've been hit harder than other groups during periods of economic instability like the current period. And this reduces the sales at these companies because the customers have less discretionary funds. They're emphasizing necessities. They trade down to lower priced goods, which means that there are lower transaction values, and fewer of the customers exercise their early purchase options on their leases. Additionally, in this industry, there was a pull forward in demand over the last couple years. And the issue is that items that customers have purchased over the last years have not worn out yet, and they don't need to be replaced. And, obviously because these people are, watching their funds, there's no reason to go out and replace them. And another reason that's a little bit more recent is that there were lower income tax refunds this year. And those income tax refunds are a fairly large source of spending money for subprime customers, at least on a seasonal basis. Just to expand a little bit, so the customers at both these companies, Aaron's and Rent-A-Center, are riskier than customers at another company that we cover called Conn's. Conn's customers have FICO credit scores that are over 550, and Conn's business model is a little bit different. They do in-house financing of purchase transactions, so the customer actually purchases the item and then finances it. Whereas at Aaron's and Upbound, the customers are a bit more risky. They cater towards customers with FICO scores that are below 550, and it is a lease-to-own transaction, not a purchase and a financing transaction. Meaning that the lease-to-own it's a shorter duration and it's higher interest rates. Customers at Conn's pay interest rates in the ballpark of 30%, and I'm told it's triple digits at the lease-to-own companies. But what happens is, as conventional lenders such as banks and credit card companies tighten their own lending standards, the customers start to roll downhill, is what they call it. And so their first option for buying these types of discretionary goods is to go to Conn's. And this is for people who previously had relatively good credit. But for those people that no longer qualify for credit at Conn's, they are more or less relegated to Aaron's and Upbound. So the benefit for Aaron's and Upbound, who essentially are on the lower rung, the benefit to them is that as the economy worsens, the business rolls downhill, and that's a source of new customers for them. The other side of that is that those customers are more risky. But what it means to them, to a certain extent, is that those subprime customers are a captive audience. And when I say captive audience, it means they can't get credit at conventional retailers. And so during an economic downturn, the customer base expands. And what happens, though, is as they get too many risky customers, these companies, Upbound and Aaron's, they tighten their own underwriting standards, and this has the impact of limiting the number of customers who qualify to do business there. And what that does is it reduces sales. So you have this ongoing dynamic where the management at these companies has to strike a balance between limiting the write-offs for people who buy things and can't pay for them, and choking off sales by tightening up their underwriting standards. As I said, both these companies are in somewhat of a state of flux following recent acquisitions. Upbound, which was again the legacy Rent-A-Center, they acquired Acima, that's spelled ACIMA, in 2021. What Acima does is they do their leasing through third-party retailers. And by that I mean names that you know, such as PC Richard, Best Buy, Ashley Furniture, and Bob's Discount Furniture. And they do this through kiosks that are inside the third-party retailers. And essentially that Acima unit is more or less tagged to be the growth engine of Upbound, and Acima is now 54% of the revenue. Again, on the acquisition front, Aaron's acquired BrandSmart in 2022. BrandSmart is an appliance and electronics retailer with 10 stores in Florida. And the purpose of acquiring BrandSmart was really to, number one, diversify into retail, and then number two, get the benefit of BrandSmart's product mix, because a lot of their products are appliances, and appliances are a much more reliable source of revenue than some of the other more discretionary things that Aaron sells. And so really appliances have a certain characteristic of being necessities, because when a washing machine breaks down or a dryer breaks down, you have to buy a new one, or a refrigerator. And so these are not seasonal purchases like electronics. And the other benefit is that appliances carry along with them a fairly high margin due to sales of attachments, is what they call it in the industry. And that's essentially things that are after the initial purchase, such as a warranty. So as I said, looking ahead, the future risks are basically that this lease-to-own business model is best in a down but a stable economy, and that remains to be seen as to what's going to happen, as to how deep the recession might be. There are also three other retailers that we have an interest in due to their connection to the home furnishing industry. They are owned by a company called Franchise Group, and those three are American Freight, Buddy's Home Furnishings, and Badcock Home Furniture. All three, not surprisingly, are having their own operational difficulties. And the problem for Franchise Group is that these three home furnishings companies constitute about 40% of the revenue for Franchise Group. So they basically have a pretty high concentration in one industry. There's some bad timing that's associated with that. But the bigger problem is that there's a lack of diversification. So sales at all these three were down 15% on a combined basis. The Badcock unit had the worst sales. They were down 27% in the last year. Their comps were down 19%. And their problem is essentially they're having difficulty transitioning their customer financing to a third party, which had been in the works for a while but hadn't been consummated. The worst overall performer of these three is the American Freight unit. They reported an operating loss of about $86 million, of which $75 million was a goodwill write-off. Their overall loss came from lower demand following some poor execution by management last year. They wound up overpaying for what was essentially the wrong mix of inventory. And this happened during a period of supply chain problems when they really weren't able to get the type of inventory that was their mainstay. And so what happened is sales dropped because the inventory didn't match the customer's tastes, and it forced the company to report a lot of discounting. The final one of these three companies is Buddy's. It's a lease-to-own retailer. Just like, they're in the same niche as Aaron's and Rent-A-Center. They also sell to financially distressed customers. And just like Aaron's and Rent-A-Center, their subprime consumers have been hit harder by the macroeconomic events than most consumers. And as I said, these three, the problem to Franchise Group is that these three account for about 40% of the revenue at Franchise Group. And that concludes the spotlight on Upbound and Aaron's.
Thanks, Dave. As we move on, cash flow to sales. This essentially highlights the company's ability to generate cash, through various measures, EBITDA, changes in working capital, capital spending, et cetera. So, it's no surprise we mentioned EBITDA was down for most companies. Thus, it's not a surprise that free cash flow is down, in this slide. Now, EBITDA is down on occasion. Companies like Kirkland, I mentioned working capital is also part of this. Kirkland was able to free up quite a bit of inventory, and you can see the big swing. They were negative 10.7 last year and improved to not exactly stellar, but at least in positive territory, I think, due to that working capital swing. And then you look at a company like Wayfair, who faded further. And then you kind of say, well, what happened? How did they fall so far? Looking a little closer, remember these time frames are trailing 12-month years, so it's most of 22 versus 21. Well, in 21, they generated almost 300 million in EBITDA, whereas in 22 they lost about 300 million in EBITDA. So that's a $600 million swing, and then they're still investing in the business. So that's how you get to Wayfair's negative 8.6. As far as the stock chart, sometimes it's interesting just to get a peek. I think what jumps out is the huge swings, and I think overall markets tend to overreact. Many of these are down significantly, and a few of them are up. But numbers can be deceiving or misleading, and just like the big picture, I took a closer look at some of those that showing the positive stock. Remember, this is just two random dates, yesterday from the year before, and I look a little closer, and Williams-Sonoma was just about flat, closing at $120 a share, but about a year ago they were over $200. And Wayfair, who was up to $55, up 15%. A year ago they were over $300. And RH, who's also up 16%, and the stock is close to $300. Well, a year ago they were over $700. So, just sometimes worth looking to see the general trend, but I think you also need to sometimes see the bigger picture. And if we move on to our last spotlight account, Kirkland's, I think from some of the previous slides, you can kind of tell that they've had some issues. Looking at this company big picture, I think it's important to realize that they had problems going back pre-COVID, going back to 2019. There was top line pressure. Comps were falling. I think at one point negative 10% or so. They were facing escalating tariffs, falling demand. EBITDA margin was down in the low to maybe mid-single digits. So pre-COVID, they were not in the best situation. Then they had the surge of 2021, like I've mentioned, like most had. But where do they stand now? Well, they haven't really been able to sustain that top line growth. The macro issues are really hurting their consumer. And then I think they also lost a little bit of focus on their target customer, which was the lower income customer. And when things were selling like hotcakes and anything they had would sell out, they got tempted to try to pad margins a little bit by bringing in a higher quality good, a higher price point good, so more furniture and other things that now when the market turns again and people stop spending, especially their customer is very susceptible to. So they've had that problem now in the last year trying to get those customers back. I mentioned before they're closing another 10 to 15 stores this year. A little while back they were at got the number of stores, but they've closed since 2019. They've closed almost 100 stores, including these 10 to 15 they're closing now. They're at about 350 now. That was actually their low 340s now. They had said 350 was their sweet spot, but now they're at 340. They're closing another 10 to 15. So I think their store base is a little weaker than they anticipated. As far as the big picture of the situation, you had the CEO announced his retirement in April, and he's gone by May. So, it's kind of a bit sudden. There's no replacement in place. It's a tough situation. So, not exactly sure what happened there, but yeah, it's not exactly the situation you want as far as a smooth transition to the next leader. Debt, they actually don't have a ton of debt. Just 3 quarters ago or so, they had no debt, but they're impacted pretty quickly by underperformance, and they suddenly have 35-40 million outstanding on the revolver. And when you're not making any money, it turns into a pretty tight situation. As of June 8th, availability was down to 12.4 million. They also had about 7 million in cash. So, down to about 20 million, which is starting to get a bit tight. Now, the good news, I would say, is, the cash out the door that you look at always is, the capital spending and interest expense. So for the full year, it probably shouldn't be much more than $7 or $8 million, and you have 20 million liquidity. Now, the bad news is it doesn't account for cash burn. So you'll be watching these next few quarters are pretty vital to, the company being able to, get into 2024 and make a run of it. And wrapping up, looking at some leverage ratios, debt to EBITDA is how many times, debt is greater than EBITDA. And we've always said pretty much after like 3.5 is when you start considering a company as leverage. It starts hitting 4, you start showing a little more concern. Now, Williams-Sonoma has no debt, so they would be at the top as the healthiest, but there's no calculation there, so they're not in it. The others are all relatively healthy, if not seeing their ratios growing a bit. RH actually jumped into that territory above 3.5. So suddenly they were soaring before. Suddenly they're a bit leveraged, and then not showing are companies like Kirkland and Wayfair, which have negative EBITDA. Again, you can't calculate.
Yeah, and just to comment on that, Aaron's, obviously, we see the debt from the acquisition. They had a clean balance sheet last year. And on Upbound, the deterioration in the overall ratio was driven by operations. Actually, their debt fell, but their EBITDA fell even more.
And then we move similarly to interest coverage, which is how many times EBITDA, or your cash generation, covers your interest expense. Williams-Sonoma, again, has no debt, so they have interest income, so they would be the strongest and not showing there. All the others are showing some weakening trends. Kirkland and Wayfair, once again, they have negative EBITDA, so they can't cover interest at all. In fact, why this ratio is kind of important is that underscores that any interest expense that they have to actually borrow more to cover, because they're not making money to cover the interest. And I would say overall, for the last 5-7 years, it's lost a little bit of relevance. It used to be really the silver bullet, one of the most important ratios we look at, but interest rates were almost nil. So now that they're finally starting to move up again, and it becomes more meaningful cost component for a company, this ratio is starting to come a little bit more into the forefront again. Now, percentage available under the credit facility, this isn't an end-all be-all, but one of the reasons why we look at this is when a company's getting tight liquidity-wise, their last few ways to get cash is borrowing under their bank revolver, or stretching out payments. So that's why we start to look at it to get a feel of where they stand. I think you also have to consider how much cash they have on hand, and do they have substantial assets that they could tap. So a couple other things to consider, big picture. Looking at Kirkland, they had 17.4 million available at the end of the last quarter, which is 19% available. Kind of a tight spot. If they had 100 million cash, then you would say, well, this doesn't really mean so much. Now, they only had 7. But even that 7, if they were to use that to pay off the revolver debt instead of holding it as cash, liquidity would improve as far as the calculation percentage available, go from 19 to like 27%. So, still somewhat concerning, but, we just kind of have to keep an eye on where cash levels are. Similarly, they had just amended their facility in March, and they boosted it from $75 to $90 million. So it seems like a liquidity positive event, seemed like a good thing. But also remember, companies had worked hard to correct their inventory issues. So they had reduced inventory pretty substantially, and now their borrowing base was way down, what they're allowed to borrow. So as of June, their borrowing base was only about 57 million. So in essence, it didn't really matter if the revolver was 75, 90, or 300 million, because borrowing base helps to protect borrowing levels for lenders. So in this case, Kirkland doesn't really have too much more flexibility. And then lastly, just looking at these credit ratings across the scope here, and not a surprise, things are kind of on the downside at the moment. Most are sitting on recent downgrades. Kirkland showing as the weakest at E2, and quite honestly, they're probably borderline F1. They're really going to need some improvement in performance. This doesn't include for the recent bankruptcies of Bed Bath and Tuesday Morning. And I would say outlook-wise, hopefully these companies could get through this year and hopefully see a turn in spending and demand in 2024. Any questions? You can always type them in or reach out to us after. Just give it a second in case anyone wants to type in any questions. Like I mentioned, all our reporting has our contact info. Feel free to reach out. Love to hear from you, and thank everybody for your time, and have a great day.